Imagine having to load a wheelbarrow full of cash to go grocery shopping. Sounds pretty odd, right? But it can be true and has happened before in many countries. This is what happens when a currency loses its value. But is it possible that this can happen to the dollar? We will tell you what can happen. Hey people, welcome to Moneymaker. Moneymaker is a channel dedicated to helping others become financially independent through cryptocurrency trading and investing. The FIRE movement, financial independence, retire early is our focus. We will share our views on Bitcoin and all cryptocurrencies, interesting stocks, and online moneymakers. In today's video, we will be talking about what would happen when the dollar falls, or if the dollar would lose its value at all. But before we start, make sure to hit the subscribe button and turn on the notification bell. Done? Let's get started. Currency fluctuations are the expected outcome of floating exchange rates, which is the standard for many major economies. Many factors influence exchange rates, including a country's economic performance, the outlook for inflation, interest rate differentials, capital flows, and more. The exchange rate of a currency is generally determined by the strength or weakness of the underlying economy. The value of a certain currency can vary a lot in just some time. Most of the time, people don't pay attention to exchange rates because rarely do they need to. The average person's daily life is conducted in their domestic currency. Exchange rates only come into focus for occasional transactions, such as foreign travel, import payments, or overseas remittances. An international traveler might prefer a strong domestic currency because that would make travel to Europe inexpensive. But the downside is a strong currency can exert a significant drag on the economy over the long term, as entire industries are rendered non-competitive and thousands of jobs could be lost. While some might prefer a strong currency, a weaker currency can result in more economic benefits. The value of the domestic currency in the foreign exchange market is a key consideration for central banks when they set monetary policy. Directly or indirectly, currency levels may play a huge role in the interest rate you pay on your mortgage, the returns on your investment portfolio, the price of groceries at your local supermarket, and even your job prospects. With that being said, let's now look at the matter in hand, which is the US dollar. The US dollar is highly valuable and is a very powerful currency. It is the reserve currency of the world. This means the central banks have a lot of dollars reserved. The US dollar declines when the dollar's value is considerably lower compared to other currencies in the foreign exchange market. This shows itself as a decline in the dollar index. Generally, this means a foreign currency, such as the euro, can buy an increasingly large amount of dollars with their currency. A falling dollar can also mean a fall in the value of the US treasuries. This drives up treasury yields and interest rates. Treasury note yields are the chief driver of mortgage rates. It can mean that foreign central banks and sovereign wealth funds are holding fewer dollars too. This lowers the demand for dollars considerably, and anyone who has dollars would want to give it away. A weaker dollar buys less in foreign goods, which in turn increases the price of imported goods, contributing to inflation. As the dollar weakens, investors in the benchmark 10-year treasury and other bonds would want to sell their dollar-denominated holdings. Contracts for oil and other commodities are normally denominated in dollars. And because of that, for a while now, there has been an inverse relationship between the value of the dollar and commodities prices. Essentially, the value of the dollar falls. The dollar-denominated prices of these commodities must rise to reflect their unchanged intrinsic value. On the plus side, a weakening dollar helps US exporters as their goods will seem cheaper to foreigners. This would boost the United States' economic growth, which attracts foreign investors to buy US stocks. But there is a limit to this. If enough investors leave the dollar for other currencies, this could cause a dollar collapse. This is mostly a theoretical concern. The probability of this happening is extremely low. In 2010, the Foreign Account Tax Compliance Act demanded foreign banks and other financial institutions to disclose information regarding income and assets held by US customers. Its goal was to find wealthy US taxpayers who were hiding money offshore on purpose. It also intends to stop foreign banks from using tax evasion as a profitable line of business. Many were worried foreign banks would drop US customers to avoid compliance and hence pushing them away from dollar-denominated assets. On October 16, 2013, China allowed British investors to put in $13.1 billion into its highly restricted capital markets. This made London the first trading hub for the yuan outside of Asia. This is just one way China is trying to encourage central banks to increase their holdings of the Chinese yuan and is the biggest potential threat to the value of the dollar. China intends to use its yuan to replace the dollar as the world's reserve currency. Since then, China has been devaluing the yuan against the dollar. This is being done so that its leaders are worried the economy is growing too slowly. The devaluation purpose is largely achieved through the continuous purchase of US dollars by the Chinese central bank, and it's clear that China's actions have a significant impact on the value of the dollar. The dollar declined 40% between 2002 and 2008. This was in part because the US current account being a $702 billion deficit at the time. Over half of the current account deficit is owed to foreign countries and hedge funds. The dollar strengthened during the recession as investors wanted a safer refuge in comparison to other currencies. In March 2009, the dollar resumed its decline thanks again to the US debt. Countries like China and Japan believe the US government won't support the value of a dollar. This is because a weaker dollar means the deficit will not cost the government as much to pay back, and hence creditors have been changing their assets to other currencies over time to balance their losses. This has caused many to fear that this could turn into a run on the dollar, which would erode the value of your US investments fast and drive inflation. Some predict that the euro could replace the dollar as an international currency. They point to the increase in euros held in foreign government reserves. Between the first quarter of 2008 and the first quarter of 2020, the holdings of euros almost doubled $1.16 trillion to $2.19 trillion. But the facts do not support that theory. At the same time, US dollar holdings more than doubled from $2.7 trillion to $6.7 trillion. Dollar holdings are 61.99% of the $11 trillion of total measured reserves. That's only slightly less than the 62.94 held in the first quarter of 2008. The International Monetary Fund provides details about foreign exchange reserves for each quarter with the coffer table. China has been putting a lot of work into making the yuan more powerful. They are the second largest foreign investor in dollars. As of June 2020, it held $1.07 trillion in US Treasury securities. China periodically hints it will reduce its holdings if the US doesn't reduce its debt. Instead, its holdings continue to increase. The US debt to China was 15% of America's debt to foreign countries. Japan is the largest investor with $1.26 trillion in holdings. It buys treasuries to keep the value of the yen low so it can export more cheaply. Its debt is 196% of its gross domestic product. Many believe that the dollar won't collapse for a number of reasons. Firstly, it's backed by the US government. That makes it the premier global currency. In addition to that, it is the universal medium of exchange. This is majorly because of the sophisticated financial market. Furthermore, most international contracts are priced in dollars. And lastly, the most obvious of reasons is that the United States is the world's best customer. It's the largest export market for many countries. Many of those countries have adopted the dollar as their own currency, while others peg their own currency to the dollar, as a result of which they have no incentive to switch to another currency. Also, many in Congress wish for the dollar to decline because they believe it will help the US economy. A weaker dollar lowers the price of US exports relative to foreign goods, and its products become more competitive. In fact, the decline in the dollar helped to improve the US trade deficit in 2012. But none of us wish to go shopping with a wheelbarrow full of dollar bills, do we? And it's always good to be on the safe side and have investments in other things like gold or other commodities. With that, we come to the end of today's video. Do you think the dollar would collapse? Let us know in the comment section below. If you found it interesting, make sure to hit that like button and stay tuned for more interesting videos. See you again in another video. Until then, bye!